In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, welcome back to all of our market rebels and YouTubers and Stu. I'm still trying to get my bearings from Coronado. We had a fabulous time at our little, I don't know if it was actually a RebelCon, but a little trading event out there. It was an awesome deal. But as you know, flying west and then flying back, killer. So I'm
always a tough time trying to get grounded, so to speak. Yep.
Yeah, exactly. I don't even know what day it is. But I think we had a little bit of a roller coaster market today. Gapped up, sold off quite sharply, and then kind of in the last half came back. And I think we were up about a 0.5% or so last I saw.
About 0.5%. Funny how it kind of closed basically unchanged.
Yeah. Lots of ups and downs, and overall not a whole lot of net gain.
A lot of days, that's what we get. Yeah.
That's the markets. So that's a little bit of what we're going to talk about today. So as always, let's kick off with our Chalk Talk for anybody who might be new. Chalk Talk is a little bit of a little thought question, and we would encourage you to kind of write down an answer of what you think it should be or what your answer would be, and then we'll come back and revisit it at the end.
Write it down.
Definitely write it down.
You got to commit to it.
And so what I thought would be a cool topic today for us, Stu, just because we get a lot of questions on this during Q&A and also during volatile markets like this. A lot of times we'll see the volatility spike up. People say, man, my account's sinking or I'm underwater, and let me start selling some options to try to mitigate this, which isn't necessarily a bad strategy. It's just that most people do it the wrong way. So that's what we're going to talk about is time decay of out-of-the-money options.
Not to mention, some people might lock themselves into a loss if it's really down too far and they start selling that crap down there.
That's a whole different story and absolutely true.
And we'll get to that another day. Yep.
Yeah, you can't just write your way out of, sometimes people say, oh, keep writing the covered calls, just keep writing it. Well, that's not necessarily true, because if it continues to fall, you might end up locking yourself into a loss, or
if you get the
have
big
to
pop
roll
on
for debits on the way up to try to unlock yourself out of that. You can definitely get your hands tied quickly.
Yeah.
So we're going to talk about out of the money options. And the main reason we're going to do that is that traders often sell the out of the money options. And the reason is that they want to collect a premium. Again, a variety of reasons, but usually when markets are acting up like this, but they have a relatively low chance of being assigned. And so that's why they're attracted to these out of the monies. However, because the out of the monies are cheap, right? They're out of the money, they don't command as much of a premium, that traders often try to hold until expiration. So they'll say, well, if I sold the at the money option, I might get $4 for it. But because I'm selling this way out of the money option, I'm only going to get 75 cents. And I don't want to sell it for 75 cents and buy it back for 30 cents. So I need to hold it all the way until expiration.
Yeah. Yeah.
I knew you know where I was going with this one, but it's
big mistake. But go ahead.
Exactly, it's a common tactic, and it's a common mistake, and we're going to show you why that is and why it's really a bad idea. So here's a little graphical version of it. Here's a covered call, or it could be a naked put, but let's say that the stock is down here at 100. So
wait a minute,
remember that.
Time out. 1 second. Time out. You trying to tell me that a naked sale of a put is the same thing as a covered call?
Oh, we've talked about it. It's a synthetic. Absolutely true.
God, man, I got to read up on that. Go ahead. Go.
Well, it is something that a lot of people find confusing, but mathematically they are the same thing. Synthetics. If you own the stock with the obligation to sell, it's exactly the same thing as having the cash with the obligation to buy. Just a question of when you're buying the stock. So they have the same risk profiles. So here's our current stock price, and let's say that stock's at 100. Remember that there's always a bell curve over the current stock price. That's what our volatility shows us.
Current stock price. Everybody remember.
Price. So here we've written,
it's moving. It's going back and forth. It's moving.
The bell curve moves every single day, and it gets wider and taller depending on if time is going by or if volatility is increasing. Mm-hmm. But we've written the 110 strike, and notice that there's just this little tail out here. Mm-hmm. And so traders will say, well, look, the stock's down here at 100, and I just don't see it, certainly not a very good chance for it getting up past 110. So I want to write these 110s, and then I need to let it just completely bleed out to zero.
Should I sell those calls if I want to sell the stock at 110?
That's a lot of people think that you're going to sell at 110.
I'm being, for everybody out there that knows me, I'm being sarcastic. And for those of you who don't know me, I'm being sarcastic. That is not a reason to sell that call.
Yeah. Everybody thinks that's the reason we choose that strike. And it's absolutely not. But here's the thing that you have to be aware of whenever you are selling out of the money options. And to make the point, we're going to start with an at the money. And the reason that we start here, Stu, is that most people, when they're taking training classes, books, will almost always show an at the money time decay curve, and they never show it for an out of the money or an in the money.
Yeah, I'm going to go with like 99% of the people if they were forced to draw a curve of decay, they're going to draw this one, right?
They're going to draw this one, even if it's an in the money or out of the money. And it's not really their fault. This is just the way it's always been presented.
Yeah.
So traders assume that all time decay curves look like this. So for somebody who might not be familiar with it, what we've got here is 100 days till expiration across the horizontal, and here's 0. This option was trading for 10, and over time we can see it's not a straight line, but it's fairly flat through here, and then whoops, goes right off this curve. So the thing that you want to watch is that in the first 75% of that option's life, going from 100 days to expiration to 25, you are going to lose 50% of the premium. Now, a lot of people think that you would lose 50% after 50% of the time. It's not a straight line.
No.
But what does that mean?
No.
It means in the second half, in the final 25% of the time, you lose your second 50%. So think about that. To lose the first 50% of the option's value takes 75% of the time. And then to lose the second 50% takes only 25%. So once again, this is the reason that most traders say,
I've got it figured out. I need to hold into here. If I've worked this hard, so to speak, I had to wait 75 days to get 50% out. I can get that same amount just for 25% of the time. So therefore,
and this is the angle that Bill and I come from, folks. If this is the decay curve for an at the money option, we want you to start thinking about the alternative.
Yes.
If this is an at the money option, could it be different for an out of the money option or an in the money option?
At least
that's where we want you to go with this. Just
right.
Open your mind, start thinking about the variety of different ways these things happen, and perhaps something will open up to you that you didn't really think about before. That's our angle for this. That's what we're trying to do. Go ahead,
and
Bill.
Most of the time that's going to be true because, as we always tell traders, everything changes. As time changes, at a minimum is going to change the shape. Volatility changes. You change to a different strike, different expiration. The stock price changes. All of these things change. So don't ever assume that it's a static. Absolutely, it does.
This curve, if it becomes more at the money versus more out of the money, this curve will change. And vice versa. If it goes more out of the money, the curve will change, and it may go back and forth, and the angles and the descent angle it's dynamic, just like the bell curve is dynamic. It is dynamic as well.
It's always going to change. So when you see stuff like this in a training class or in a book, it's really meant to be a stylized look of how an at the money option looks. Most of the time, it's going to have this general shape, but that doesn't mean that that's how all options decay. It's just an at the money.
Right.
So now let's take a look at the out of the monies. Now, before we jump slides, I want everybody to really get this image in their head. Fairly flat for the first 75% of the time, and then boom, off a cliff. In the second part, or this 25%, we start to go off a cliff. But now watch what happens when we go to out of the monies. Out of the monies decay in a different way. So the out of the monies decay faster in the first half of their life, exactly the opposite.
Yeah.
And when we talk about out of the money, little side note here, that doesn't mean that we're talking about something that's 10 cents out of the money, maybe more 10% out of the money. So if you've got a $100 stock, maybe the 110 strike for the call or the 90 strike for the put, something like that before you're going to really start seeing this effect.
Yeah. Which is also a bit of a range. Look, it's not like if it's 9%, is it in the money or at the money? It's a range. It's ish. It's 10. It's 8. It's 9. It's 11. It's it's a sliding scale. That's the point. It's not a finite number.
Right. Now, the further out of the money that you go, all things being equal, the more this becomes true. The more it's going to decay in the first half of the option's life. And that's interesting. It catches a lot of traders by surprise because it's exactly the opposite of the at the money. Exactly the opposite of what they've been used to seeing in that stylized time decay curve, and it causes great misperceptions. And of course, that means great mistakes. So let's take a look at an example. And before we do, as always, Stu, let's get our people educated. For anybody who's more interested in taking their options trading to a higher level, please check out marketrebellion.com/get started. Lots of free stuff, free courses, videos to help you get started and to at least get you channeled into the right direction. It's so important when you are starting your educational career with trading. So let's take a look at an example here. Let's say that we put the stock at 100 and we go to a pricing model. We give it 30 days to expiration, 30% volatility, and it tells us that the 110 call, right, 10% out of the money, is worth 61 cents.
This is right from a pricing model?
This is right from a pricing model.
Okay.
All right, so now the question is, how does the time decay look? Is it going to look like that standard at the money decay curve? Well, take a look at it. There's what it looks like.
Let's kind of go back 1 second here. Is it going to be a straight line, the same amount of pennies every day? No.
Nope.
Is it going to be the falling off the cliff at the end? No.
No.
It's going to be this.
Definitely no. It's going to be this. Now, just for reference, kind of drawn one in here, you can see it looks quite different. The blue one, the at the money, is kind of bowed outwards, whereas the black one is pushed inwards.
Now look, take this in a practical application. Towards the end, 10 days left. There's no money left. There's no money left in this option.
Right. Yeah.
right? You still have the same obligation, but there's no money left. It's
There's
from
no money in it.
today. It's not where you sold it. Nobody cares where you sold it. The market certainly doesn't care where you sold it.
Doesn't
It's
even know.
today. If there's no money left in it, what are you doing with it?
Right.
Go ahead.
And why would you expect it to go off a sharp curve if there's nothing left to decay? It's already done. So
It's already done. It's gone.
So the
It's
thing
history.
is to take a look here. That here's our 61-cent option. That's this price up here. And it's 30 days. So the halfway point is right here at 15 days. So take a look at what happens in the first 15 days. You have lost 42 cents. And in the
Out of
second
61.
of the 61, and in the second, that's 69%. And in the second 15 days, you've lost 16 cents. Now, a little side note, some people might be saying, hey, wait a minute, this doesn't add up to 61 cents. Well, that's because there's a time decay of about 3 cents going from day 16 to 15. So we'd have to account for that. But roughly, if we just look at that first, and we'll look at a chart here in a moment, but right now, I just want you to see how much more we have lost in the first half of the option's life. I mean, if we look at it, that's almost 3 to 1.
And it's give and take. It's like vols change.
That's correct. Right.
This is assuming all else, and I mean all else is equal, which of course it's not. So it's an ish. It's the idea. It's the concept that more's going to dump in the beginning than the end.
We could create different scenarios with lower volatility where we might get 80% that bleeds out in the first half. But it's, again, like Stu said, it's the concept. Just that you're going to get, if you're at least 10%, let's say, as a rough idea, out of the money, you're going to see more of it bleed in the first half, exactly opposite of what people believe. So let's take a look at a table of this graph.
Here's a little side note. Can we go back there 1 second? Just 1 second. Here's a little side note. Here's an example of how a change in implied volatility might affect these curves. Higher implied volatility pushes deltas towards 50, towards a 50 delta, both for in the money and in the money and out of the money. So if you think about it in real life, if you have higher vols rising, higher volatilities, this black line is actually pushing. Exactly. Towards the blue line, towards a 50-ish at the money, because that's what a delta of and at the money is, the 50 delta, right? Yep. So it's, you got to take these things into account. Go ahead, sorry.
It's good point, because if we have super high volatility, you might get the opposite. We might be behaving more like an at the money. So let's go back to this table.
It's out of the money, right?
Here we've got 30 from day 30 down to 16. So there's our first 15 days. And over here, we've got day 15 down to day 1. And if you look, we started at 61 cents. And if we sold this for 61 cents, after 15 days, we've collected 42 cents. That's just the difference between 61 and 19. But if we continue to hold it into the second half, take a look what happens. We've only picked up 16 cents, going from the value on day 15 is 16 down to 0.
So ask yourself, people, why would you keep this option on day 15? I don't know. I can't come up with an answer.
You have nothing to hedge your downside. When we first sold this, we had 61 cents of a downside hedge, assuming it was meant to be a hedge. And on this date, doesn't matter what you sold it for, it's worth 16 cents.
Yeah.
So it's kind of a double whammy. It's a slow bleed, and you've got nothing to protect. You've got 16 cents of a hedge to the downside. Also, take a look down here, Stu. Days 5 through 1. How much are we losing from 5 to 1?
I'll tell you. Here's what I'll do. Next time I do this, I'm gonna ride it into the last week. That's 7 through 1, and I'm gonna forego rolling it
for 61
and collecting,
cents.
20 cents a day in decay on the next week while I'm trying to pick up 2 cents here. Now, I think that sounds like a good idea. Should I do that?
Yeah, or wait till day 5 and collect a whole bunch of zeros. See, that's the thing.
That's a good idea as well.
Remember,
folks, the obligation is the same.
Same obligation
at all times.
Probabilities change, and that's why the values change. But it's
prices change, the probabilities change, but the obligation remains exactly the same. It's still an obligation, in this case, to deliver the stock at 110.
Yep. So you're saying that I don't care if you even sold this for $4. On this date, it's
Doesn't
worth
matter.
16 cents. And
That's
that's
right.
what we have to, it's a day by day decision. Would I sell
Moving
it?
forward.
Am I willing to hold from day 15 to 14
Yeah.
at 16 cents? If the answer is no, we've got to do something. If the answer is yes, do it. And then we ask tomorrow, given the current price, am I willing to hold it from day 14 to day 13? If the answer is no, then we have to do something. If yes, continue to hold it. It's a day by day decision. It doesn't matter where you sold it.
All of which has nothing to do where you sold it.
Gone.
Nothing.
It's absolutely gone.
Zero.
But that's where a lot of people do it. They'll say, hey, look, I
Because they
got
fall back on
61 cents, and 16 cents is a pretty good chunk of that, and it's going to be coming out rapidly in the second half. Let me continue to hold it. And it's absolutely the worst idea you can do, and yet so many traders fall into this trap.
And that example exacerbates itself when you're selling for higher numbers, because you kind of fall back on that. I mean, if you sell them for 5 and now it's down to 75 cents, or in this case, 61 cents, you're like, oh, okay, well, I got $4 and change in my pocket, so I'm not going to worry about it. It's irrelevant, completely irrelevant. It's the past, it's history. It's nothing you can do about what happened yesterday. It's about what's happening today and moving forward
right now. Yep. So now a little bit of what you just talked about. Let's take a look at how these curves can change over time and why we have to be very careful when we're teaching this stuff, which is why we always say all things being equal, especially in the options market, because all of this changes. So here's the time decay curve that we just saw in black up at 61 cents. If we shot that same screenshot, same option pricing decay at 40%, it just shifts it out by the red. But look what happens if we pump it up maybe to 80%. See, now it's starting to look like that curve that Stu talked about. It's starting to look more like an at-the-money option.
Sure,
Why?
that's higher volatility, pushing deltas towards 50, looking like an at-the-money option.
Like an at-the-money option. It is still an out-of-the-money option, technically speaking, but because of the high volatility, it's behaving like an at-the-money option. So you want to talk about something that's really weird. This is why time decay gets very complicated, and to understand how to make the best use of it. Main thing to get from this is that if you are selling out of the money options, again, let's call it 10% or more out of the money, that you don't want to just try to hold into that steep part of the time decay curve. The majority of it comes out in the first half.
It's already gone.
You've already gone. So if you want to make the most of your option selling, sell 2 of them up front. So if we go back to that other slide, if I do this for 15 days, I can pick up 84 cents. The second round, I've picked up 42 cents as opposed to 16. So if you think 16 is worth holding on to, you should love 42. And yet people don't. They just go, nope, I'm going to continue to hold this because I'm going off the steep part of the time decay curve. Both of those are false.
I'm going to ride it into expiration.
I'm going to ride it into expiration. And they're both bad ideas. They're both false.
Come hell or high water, I'm not buying it back.
I'm not buying. I'm going to let it expire worthless.
Yep.
So the whole idea with the option sellers is that option sellers should consider closing out of the money options at the halfway point and writing a new option. And what will happen is you'll end up holding the position for the same amount of time. In that example, we did 2 15-day options. So it's still 30 days. But what will happen is you will collect far more money. And you also get better downside hedges, because when you roll it, in that example, we sold it at 61 cents, we write it down, and then we sell it again at 61 cents. Well, that's better than having it at 19 cents.
More money.
Might as well. Now, if you're ever in doubt, what do? Check with your pricing models. You were just talking about this on TOS the other night in Q&A, showing the Analyze tab and how we can actually do this. This is really
hey, folks, don't believe us. I mean, go check it out for yourself. It's all there. We're not making this up. I guarantee that.
Yeah. And so just go in there, and if you're ever in doubt, check with a pricing model, check with your Analyze tab, and you can make much, much better decisions. But the one thing that we wanted to get through to everybody is that when you're selling out of the money options, again, 10% or more, you should at least be considering buying them back at the halfway point and rolling out to the next expiration for another 50% of the time. And you're going to come out way ahead.
Just think about it and run the model. Everybody likes to back test. Well, run the model and test this out and see what it looks like.
Yep, it's a much faster way. Now, here's a real world example, because Stu, sometimes people are going to say, does this really work in the real world? Well, here is, what have we got? CMG. And I know it's a little hard to...
This is this week.
Yeah,
This was this week, guys.
So just to enlarge it, the information that we're looking here on the blue line is 4 days to expiration, and it's the 1,500 strike, and the stock is where, 16 and change?
Yep, out of the money.
Yeah, so way out of the money for the puts. These are the puts on the right. They're worth 85 cents. Now remember, it doesn't matter where you sold them. I don't care if you sold these for $10. Right now, they're worth 85 cents. It can only help you going forward by 85 cents. So the question is, do we continue to hold this for 4 days and pick up 85 cents? Or if I roll it, here's an 11-day option to the next week. Look at that, $4. What's our time? What's our theta here, Stu? 66, it looks like?
Yep, 66, yep.
So that's going to be about what, $2 and $2.40?
240, 250, yeah.
250, a little over 250. So would you rather have 85 cents for the next 4 days or $2.50 for the next 4 days?
I want to have 64 cents.
And keeping in mind that that's going to bleed slower too. Right? It's going to bleed slower. So nobody says you have to hold this for 11 days. That's another mistake. Everybody thinks, oh, I don't want to sell the 11-day because I just want to be out of it in 4. Well, fine, be out of it in 4. But make better use of the time decay.
Right. Compare the time periods. That's what we're asking you to do. Compare the time period.
So the concept is to understand which time periods decay faster and when. And that's really the thing, because we know a lot of people like to sell these out of the money options. Just understand that most of that's going to come out in the first half of the option's life, exactly opposite of an at the money. So remember, if you're not making the most of time decay, you're not making the most of your money. So we thought that would be helpful for all of our traders out there. And so now, Stu, Chalk Talk. And before we do that, as always, marketrebellion.com/get started if you're interested in some great content and videos to help you make better decisions. So Chalk Talk, I'm going to leave it up to you. It's a little bit of an open-ended question, but Stu, should you let an out-of-the-money credit spread expire worthless? Oh, he's laughing.
Before I answer that, which we all know what the answer is, or at least what Stu's going to say, Bill, is a selling out of the money put, is that free money?
Oh, it certainly looks like it. Low chance of getting hit. Let's just sell it 50 times, right?
Let's just sell it. And if we don't get the money that we're looking for, let's just sell more.
We'll just sell more.
We'll just sell more. Getting back to Chalk Talk. Should you let an out of the money credit spread expire worthless? No.
I think that's for the most part, it's a bad idea. Now,
there's a plethora of reasons why. Okay, sorry.
Not only partly for the reasons that we talked about today, it'll change a little bit with spreads, but there's one that I'm thinking of. Let me hear your thoughts. What's the biggest risk here? We ride this into expiration. I say, hey, it's expired. I'm off the hook. What's wrong with that?
You're not off the hook. You're not off the hook.
Right.
Where the window, I mean, this is where my head goes because this actually happened to me and other traders that I know. The window for OCC, which is the Options Clearing Corp, which is the other side of every one of the trades that everybody does, right? You think you're trading with an individual. You're not. You're trading with OCC, who guarantees all the trades. Their window to accept an exercise is 5:30 Eastern. As opposed to 4 o'clock, which is the close Eastern, an hour and a half later. If they can accept an exercise up until 5:30, then if you're part of the open interest pool, you have the chance to get assigned. And things happen in the marketplace in the after hours between 4 and 5:30.
And you are in the open interest pool if you didn't close it up. So a lot of people think that just when the clock strikes 4, they breathe this huge sigh of relief and go, oh, I'm off the hook. Yay, it expired worthless. You've got an hour and a half for a company to come up and say, oh, sorry, we missed earnings, and watch that stock gap down 30%, and then you get assigned.
And now, I've seen it happen too many times.
You don't know about that until Monday morning, and nothing you can do until the opening bell. So
tens of thousands, hundreds of thousands, even I saw an example into the millions.
In the millions,
I mean, it was a size trade, but stocks close at 64 and they trade in the after hours at 56, and you're short the 60 puts. And what are you going to do? It's just crazy. For Tesla, I can think of a recent example. Stock closed at 410, 418, 400 puts. were a short on a spread. Wasn't even a naked short. It was on a spread. Stocks trading at 395 in the aftermarkets. They get a sign. Bang! The stock's 356 the next Monday morning. I mean, it's costly for what? A few pennies. It's just dumb. It's you just can't do that. It's just not worth the risk versus any reward, which is pennies that you might get.
Right, because remember what we just said is that if the option is, or the spread is close to worthless, that's what the question is telling us. Should we hold it for the next half hour, 15 minutes, whatever, going into the close? Well, how much more can it decay from worthless? What's it going to do for you in that next half an hour or that next 15 minutes? Nothing.
It's all the same concept. An hour, 15 minutes, 2 days, 3 days, 4 days. Right. You got to look at the money. You got to follow that money.
If there's nothing to decay, you have everything to lose and nothing to gain. Now, let's flip it around. What if it were a debit spread, Stu, where we have the rights? It's an asset and it's out of the money worth zero. Do we hold that into the close?
Well, if my answer was absolutely no on the credit spread, I guess on the opposite side, the answer has to be absolutely yes.
Yes. Yep.
Right. Yeah.
As well, because now if it's worthless going to lose. Right. If it's worthless going into the close, it can't hurt us anymore. But it might help us if we happen to get that big news. So you definitely don't want to close a debit spread.
You never know.
So that's why we made this a credit spread going into the close, because it is a liability. So hopefully those are some points that will help you to make better decisions. If they seemed a little confusing, don't feel bad. Everybody, even astute traders, find it confusing, but it shows why you need to understand your options, your pricing, and your theory. And that's what ultimately allows you to make the most of your money. So Stu, any final closing thoughts?
I saw a quote, a tweet actually on the Market Rebellion's Twitter page, which really caught my eye. It is absolutely outstanding. It's by a gentleman by the name of Jack Schwager, and it goes something like this. Amateurs think about how much money they can make.
Yep.
Professionals think about how much money they could lose.
Fabulous.
So true.
And we heard Stephen Levick say, know your risk. You and I have always said that you're not profit managers, you're risk managers, all different ways of saying the same thing. So another little key point for everyone to keep in mind. But once again, we hope that gives you some things to think about. There's a lot of twists and turns in the options market because everything does change. And so we hope that gives you a different perspective for those of you who like to sell out of the money options. And with that, I think that's about everything I've got to say, Stu. I think anything else on your end?
No, let's do it, man.
I think we're good. We'll look for you next Thursday and want to wish everybody a great upcoming weekend, and we'll see you then.
See ya.